Let me ask you a question that might make you uncomfortable. If investing were truly about intelligence, why do 95% of people still lose to the market? It's not because they lack information. It's not because they lack effort. It's because they're playing the wrong game. Right now, somewhere in the world, capital is moving silently, without headlines, without hype, following a set of rules so simple, so disciplined, that it consistently outperforms armies of analysts, complex models, and emotional traders. No shortcuts, no predictions, no gambling. Tonight, I'm going to pull back the curtain on that approach. Not a theory, not a trend, a framework built to survive chaos, exploit opportunity, and compound when others are forced to panic. If you understand this, you will never look at your portfolio the same way again. Stay with me, because by the end of this, you'll understand why simplicity, not sophistication, is what separates the winners from everyone else. Most people believe that success in investing comes from doing more. More trades, more indicators, more opinions, more complexity. That belief is precisely why the majority never outperform. The truth is far less glamorous and far more demanding. Real advantage comes from ruthless simplicity and deep understanding. Every position you take should pass a single test. Do you truly understand why this asset should exist in your portfolio? And do you understand it better than the average participant in the market? Simplicity is not about being passive or lazy. It is about intellectual discipline. When you strip away unnecessary layers of complexity, you force yourself to confront the fundamentals, cash flows, incentives, competitive dynamics, and risk. Complex portfolios often hide ignorance behind sophistication. Simple portfolios expose weakness immediately, and that is a strength. If you cannot explain why you own something in plain language, you should not own it at all. Focus is where edge is born. Markets reward those who concentrate their attention on areas they understand deeply. That doesn't mean reckless concentration, it means selective conviction. You do not need exposure to every sector, every geography, or every new financial product. You need exposure to situations where you can accurately assess risk and probability. When understanding is shallow, diversification becomes a crutch. When understanding is deep, diversification becomes a strategic choice. Liquidity matters more than most investors admit. Being able to enter and exit positions efficiently is not a luxury, it is a necessity. Simpler strategies tend to operate in liquid markets, where price discovery is honest and execution risk is manageable. Complexity often traps investors in positions they cannot unwind when conditions change. Flexibility is power, and flexibility comes from clarity and liquidity. There is also a psychological advantage to simplicity. Complex portfolios create emotional noise. Too many positions, too many signals, too many narratives pull your decision-making in different directions. Simplicity creates calm. Calm leads to better judgment. Better judgment leads to consistency. And in markets, consistency compounds faster than brilliance. Understanding competitive advantage is central to this approach. Whether you're evaluating a company, an asset class, or a strategy, you must identify what makes it durable. Is it scale, cost structure, data, regulation, network effects, or execution? If you can't identify the source of advantage, assume it doesn't exist. Markets are brutally efficient at eroding weak advantages, and complexity does not protect you from that erosion. Finally, simplicity enforces accountability. When your strategy is clear, results are clear. There is nowhere to hide, no story to blame, no model to excuse failure. You either assess the situation correctly or you didn't. That feedback loop is invaluable. It sharpens judgment over time and builds the kind of decision-making muscle that separates professionals from amateurs. The investors who consistently outperform are not chasing secrets. They are executing fundamentals with precision. They know what they own, why they own it, and under what conditions they will change their mind. That clarity, applied relentlessly, is what allows a simple portfolio to outperform 95% of participants who mistake activity for progress and complexity for intelligence. Risk is not something you manage after you make money. It is the price of staying in the game long enough to make money. Most investors think about returns first and risk second. Professionals reverse that order. Before a single dollar is deployed, the most important question is not how much you can make, but how much you can lose and whether that loss is survivable. Every portfolio, no matter how well designed, will face stress. Markets move faster than narratives, correlations break, and liquidity disappears precisely when you need it most. That is why risk management must be systematic, not emotional. You cannot rely on instinct in moments of volatility. You need predefined limits, clear exposure controls, and constant measurement. Hope is not a strategy, and improvisation is not protection. The first rule is simple. No single position should have the power to define your outcome. Concentration without risk control is not conviction. It is arrogance. Intelligent portfolios size positions based on volatility, liquidity, and downside scenarios, not just upside potential. When one trade can materially damage the entire portfolio, the strategy is already broken, even if the trade looks brilliant on paper. Stress testing is where seriousness begins. You must ask uncomfortable questions. What happens if interest rates move faster than expected? What if correlations go to 1? What if liquidity evaporates overnight? These are not hypothetical exercises. They are rehearsals for reality. The market does not warn you before it changes the rules. Risk frameworks exist to ensure you are still standing when it does. Diversification, when done correctly, is a risk tool, not a return enhancer. The goal is not to own many things. The goal is to own things that behave differently under pressure. Too many investors diversify across assets that appear different but collapse together when volatility spikes. True diversification is built on understanding behavior, not labels. Leverage deserves special attention. Used carefully, it can enhance efficiency. Used carelessly, it accelerates failure. Leverage reduces Y. Our margin for error, and markets are unforgiving when margin disappears. Professionals assume leverage will be tested at the worst possible moment. If your strategy cannot survive that test, it is not robust. Perhaps the most underestimated risk is behavioral. Panic, overconfidence, and narrative attachment destroy more capital than bad data ever will. A disciplined risk process creates emotional distance. It allows decisions to be made based on probabilities rather than fear. When losses occur, and they will, the framework absorbs the shock so judgment remains intact. Ultimately, risk management is not about avoiding loss, it is about controlling it. Losses are tuition. Catastrophic losses are career-ending. The difference between the two is preparation. Investors who endure and outperform over time are not those who never lose, but those who never lose control. That discipline, applied every day in every position, is what separates the top tier from the rest of the market. Diversification is often misunderstood because it is treated as a numbers game rather than a strategic discipline. Owning more assets does not automatically reduce risk, and in many cases it simply spreads ignorance more evenly across a portfolio. Intelligent diversification begins with a clear objective: protecting capital while preserving the ability to compound returns across different market environments. The first mistake investors make is diversifying by labels instead of behavior. Stocks, bonds, commodities, and alternatives are not inherently diversified if they respond to the same macro forces. When volatility rises or liquidity tightens, many assets that appear unrelated suddenly move tog. Ether. True diversification requires understanding what actually drives returns and risk. Interest rates, growth expectations, policy decisions, and investor positioning, not just asset class names. A well-constructed portfolio blends strategies that succeed under different conditions. Some perform in growth-driven environments, others in inflationary periods, others during dislocations and stress. The goal is not to predict which environment will dominate, but to remain resilient regardless of which one arrives. This is how capital survives long enough to compound. Conviction still matters. Diversification is not an excuse to dilute your best ideas. Capital should be allocated with intention, not equality. When you have high confidence in your analysis, it is appropriate to express that conviction within a risk-controlled framework. The balance between diversification and concentration is where professional judgment is revealed. Too much concentration invites fragility. Too much diversification guarantees mediocrity. Correlation is not static, and treating it as such is dangerous. Relationships between assets change as market regimes shift. What hedged your risk last year may amplify it next year. This is why diversification must be monitored continuously, not set once and forgotten. Adaptive portfolios reassess correlations, rebalance exposures, and adjust as new information emerges. Time horizon is another overlooked dimension. Short-term volatility and long-term risk are not the same thing. A diversified portfolio acknowledges this by aligning assets with their intended holding periods, liquidity for short-term needs, stability for medium-term objectives, and growth. For long-term compounding must coexist without interfering with one another. There is also operational diversification, spreading risk across counterparties, execution venues, and systems. Market risk is only one part of the equation. Failures in infrastructure, settlement, or access can be just as damaging as price movements. Serious investors account for these risks before they appear, not after they cause damage. At its core, diversification is about resilience, not comfort. It should make you uncomfortable in good times and grateful in bad ones. When markets are calm, diversification may feel like a drag. When markets fracture, it becomes the reason you are still participating. Those who understand this do not chase maximum returns in a single scenario. They design portfolios that endure across many. The investors who outperform over decades are not betting on one future. They are prepared for many. That preparedness, expressed through intelligent diversification and disciplined conviction, is what allows capital to grow while others are forced to retreat. Outperformance is rarely the result of bold predictions or dramatic market calls. It is the product of small, repeatable advantages applied consistently over time. Most investors search for certainty, but markets do not reward certainty. They reward probability. The objective is not to be right all the time. It is to be right slightly more often than wrong, and to make sure the math works in your favor when you are. Edge is not a mystery. It comes from information processed better, faster, or with greater discipline than the competition. Sometimes that edge is analytical depth. Sometimes it is superior execution. Sometimes it is emotional control when others lose it. What matters is knowing where your advantage actually lies and structuring your strategy around it. If you cannot clearly define your edge, assume you don't have one. Position management is where edge is converted into results. Winning ideas must be allowed to work, and losing ideas must be cut without hesitation. Many investors do the opposite. They take profits too early and hold on to losses too long, hoping the market will validate their ego. Professional decision-making is ruthless. It respects data over attachment and process over pride. Risk-reward asymmetry is a defining characteristic of durable strategies. You want situations where potential upside materially outweighs downside, even if the probability of success is only modest. When this logic is applied repeatedly, outcomes compound in your favor. One large winner can offset many small losses, but one uncontrolled loss can erase years of discipline. Execution matters more than most realize. Slippage, timing, and liquidity costs quietly erode performance. An idea that looks exceptional on paper can become mediocre if executed poorly. This is why professionals obsess over implementation. They understand that edge without execution is theoretical, and markets do not pay for theory. Feedback loops are essential. Every decision should be reviewed, not emotionally, but analytically. Was the thesis correct? Was the sizing appropriate? Was the exit disciplined? Continuous improvement is not optional in competitive markets. The moment you stop learning from your own behavior, you begin falling behind. Patience is another misunderstood advantage. Waiting for the right opportunity is often more profitable than constant activity. Markets offer endless noise but limited moments of true opportunity. Knowing when not to act is just as important as knowing when to act. Capital preserved during low-quality environments becomes ammunition when conditions improve. The reality is that extraordinary performance does not require extraordinary intelligence. It requires extraordinary consistency. Slight edges applied over thousands of decisions create outcomes that look exceptional from the outside. Those who understand this stop chasing perfection and start building systems that quietly, relentlessly tilt the odds in their favor. Markets are not static systems. They are adaptive, competitive, and relentlessly forward-looking. The greatest risk investors face is not volatility, it is rigidity. Strategies fail not because they were once wrong, but because they were never updated when the world changed. The ability to adapt quickly and without ego is one of the most powerful advantages in investing. Facts change, data evolves, regimes shift. When new information emerges, clinging to an old thesis is not conviction, it is denial. Professionals build frameworks that allow them to absorb new inputs continuously and adjust exposure accordingly. This does not mean reacting to every headline. It means distinguishing between noise and signal and acting decisively when the signal is clear. Ego is the enemy of adaptability. Many investors confuse identity with strategy. They become emotionally invested in being right rather than being profitable. The market does not reward past success or reputation. It prices current reality. When conditions change, the only rational response is to change with them. Flexibility is not weakness. It is survival. Speed matters, but so does preparation. Adaptation is not improvisation. It is the result of scenario planning, stress testing, and constant monitoring. When you've already considered multiple outcomes, action becomes calm and deliberate rather than reactive. The best decisions are made before pressure arrives, not in the middle of it. Technology and data have accelerated market dynamics. Information that once took weeks to disseminate now moves in seconds. This compression rewards those who invest in systems, analytics, and process. Human judgment remains critical, but it must be supported by structure. Adaptable investors combine quantitative insight with qualitative reasoning, allowing each to challenge the other. Adaptation also applies to scale. Strategies that work with small amounts of capital may fail as capital grows. Liquidity constraints, market impact, and execution complexity change the rules. Recognizing when an approach no longer fits your size is a sign of maturity, not failure. Many underperform not because their ideas are wrong, but because they outgrow their own methods. There is also a broader adaptation to macro reality. Interest rates, policy frameworks, geopolitical risks, and technological disruption reshape opportunity sets. Ignoring these forces is not discipline, it is blindness. A resilient portfolio reflects an understanding of the world as it is, not as it once was. The goal is not constant change for its own sake. The goal is alignment between strategy and environment, between risk and reward, between conviction and evidence. When aligned, ENT breaks, adjustment is required. Those who delay pay the price. Those who act preserve optionality. In the end, the market does not punish mistakes, it punishes stubbornness. Investors who endure and outperform are those who treat adaptability as a core principle, not an afterthought. They evolve faster than the environment changes, and that difference, quiet, disciplined, and relentless, is what keeps them ahead while others fall behind. So here's the truth most people never hear. The market doesn't reward excitement, predictions, or ego. It rewards discipline, clarity, and those who are prepared when chaos arrives. While others chase noise, you now understand the power of simplicity. While others panic, you understand risk. While others react, you stay positioned. That difference may look small in a single decision, but over time it becomes overwhelming. This is how capital is built quietly. This is how portfolios outlast cycles, crises, and headlines. And this is why years from now, when others are still asking what went wrong, you'll know exactly what went right. The market will open again tomorrow. Opportunity will not announce itself. The only question is, will you be ready when it does? If you're serious about building a portfolio that beats the majority, don't just watch this, apply it. Because the edge doesn't belong to the loudest voice in the room. It belongs to the most disciplined mind.